Hey everybody, my name is Matthew Sambanis. I'm a certified public accountant. My firm is based in Long Island, New York. I've been an accountant for over 20 years and I've been a CPA for close to 15 years. Time flies by when you're having fun. I'm kidding. But if you like economics, finance, taxes, making money, investments, the economy, inflation, and other things of that nature, please be sure to comment, like, and subscribe. And if you feel like I'm missing anything or anything you'd like me to speak about in particular, leave a comment below and I will definitely get back to you. In today's video, we are going to discuss Schedule C, sole proprietor / single member LLC, tax return preparation, and filing. So if you're a sole proprietor, you work for yourself, or if you are the owner of a single member LLC, meaning you're the sole owner of it, you're probably required to file Form Schedule C. The only reason you wouldn't be, or one of the reasons you wouldn't be, is if A, you didn't have any income, or B, you elected for your LLC to be taxed as an S-Corp, which we'll cover in another video. Other issues that happen to arise is when people receive a 1099 miscellaneous, or now 1099 NAC, non-employee compensation forms. And when you do receive that, again, the IRS looks at that as income. But again, if you're a sole proprietor, you're out, you're mowing lawns, you're preparing stuff on, I can't think of it, one of these online operations where you get to work for people remotely, or other things of that nature. Again, if you have any income, basically you're required to report it. And if you don't, it's a felony. Again, are you going to go to jail for that? Probably not, unless it's a huge amount of money and you're doing it directly. Most of the time what happens is when the IRS finds out that you didn't report all your income, they'll send you a letter and they'll say, hey, we received information that you received X, Y, and Z in income, but per your tax return, you said you only received A, B, and C. And if you agree, sign off. And if you disagree, please let us know why. And so from there, what you do is, if you disagree, you write them a letter, you state you disagree, and you tell them why, and then you amend your tax return for that year. Case in point, let's say you sold on eBay more than $20,000. That's the old standard rule. They sent you a 1099, except you didn't report that on your tax return. The IRS says, hey, we received this information. From there, you need to go and amend your return, and you're going to want to do that ASAP, because if you received a 1099 for $20,000 and you don't report it, they're going to assume that's all taxable. But more than likely, if you're selling something on eBay, there's a cost to you, right? You have the cost of the product, you have the cost of shipping, you have the cost of advertising, you have the cost of listing fees, you have the cost of your cell phone to process orders, or your home internet, or your computer that you bought for it, and the website, and a ton of other stuff that should be written off. So if you receive one of these notices, you want to reply right away and show the true amount of income that you earned from it, if any, unless you were operating at a loss. And on the flip side, you always want to report your income anyway, because it's the law. So the issue, or not the issue, but one of the things about reporting income, and in particular profit on a Schedule C, is it's all subject to FICA. When you're the employee of a company, you pay 7.5% towards Social Security and Medicare, and your employer pays 7.5%. On the flip side, when you're self-employed as an LLC or as a sole proprietor, you pay the full 15% tax. And technically you do get a small write-off for it, but instead it really only works out to you paying 14%. So that write-off is absolutely nominal. And the way that the taxes work is, let's say you're a sole proprietor, you're earning $100,000 a year. Basically, the tax on that for federal purposes would be $24,000, $10,000 of income tax and $14,000 of FICA tax, Social Security and Medicare. If you claimed or earned this income through an S corporation and you don't show anything from it, it would just be $10,000, because they consider income earned from an S corporation to be passive, like rental income or interest income or things of that nature. But if you're actively managing that S corporation, then some of your income should be subject to FICA. There's what's called a reasonable officer compensation, which is a video that we'll do in another day. So I have the Schedule C in front of me, page 1 and page 2, and I'm going to run through it line item by line item. And if you have it in front of you, or if you'd like to print it out to follow along, that's great. I suggest you do that. And I'll just kind of cover the caveats, the important stuff of what might make sense, what might not make sense. And like I said, if you like this, please be sure to comment, like, and subscribe and all that other good stuff. So Schedule C, name of proprietor. Well, what's the name of the proprietor? You put in your name there. What's the principal business or profession? Well, again, if I was a sole proprietor or a single member LLC, I would put in tax services or accountant and tax services. If the business name was there, I would put my name, Matthew Sambanis, CPA, PLLC. If I had a professional liability corporation, which is what I would have to have in the state of New York, not just the LLC, but I have Matthew Sambanis, CPA, PC, so I do my return on a Form 1120S. Top right, put your social security number. You also put in the code for the business that you're doing. So again, just Google it, easy enough, or depending on the tax software, it should automatically generate for you. And the employer ID number. If you have an EIN, that's what you enter there. Obviously, you want to report and show that your income, you're reporting it. So line 1, gross receipts or sales. Let's use the easy number, 100,000, right? Line 2, returns and allowances. So if you had any returns or allowances, put the refunds in there that you issued to people. Cost of goods sold from line 42. So again, that's going to be your inventory, your product that you sold, any cost of labor associated with your cost of goods sold, meaning packing it, materials and supplies, if you're packaging, if you have a product, other costs associated with it, and that's your cost of goods sold. And your sales minus your cost of goods sold gives you your gross profit. Then you have other income to report. So that would be credits. You would have maybe interest income that you earn on the bank or credit card points that you earn from using your business. Yes, that's taxable. Sorry to tell you. And basically, if it moves, it's taxable. So other income goes there, and then you have your gross income. Then we move on to part 2, expenses. So line 8, advertising. Again, advertising, black and white, you should be able to figure that out, and you should know what that is. Commissions and fees. Car and truck expenses, line 9. So when we do it in the tax software, we enter the miles driven, other costs associated with maintaining the material or the car. The car, and things of that nature. Line 10 is commissions and fees. Again, let's say you're a realtor and you pay out other commissions to other realtors or finder fees or whatever the case may be. That's where you would write that off. Contract labor, same thing, paying out commissions, etc. Anything within that nature. Depletion, most people don't have depletion, so I'm not going to even cover it. Depreciation, biggest thing that would go here is your automobile. Most businesses have automobiles. Let's say you're a realtor, you use it 90% of the time for your business, 10% personal, so you would allocate it to there. Your miles would be allocated obviously equally. A lot of people confuse car and truck expense with the actual cost of the car. So those are two things. When you go and you fill up your car for gasoline and you drive miles, that's a write-off. And when you go and you pay for your car, assuming you're buying it, not leasing it, that's also a write-off. And we'll also discuss leasing as well. And depreciation, you can take bonus depreciation, which gives you, another video for another day. Up to 18,000, and if the car or truck weighs more than 6,000, then you usually get to write off the entire truck that year if you so choose to. For federal purposes, most states don't allow bonus depreciation, at least New York doesn't. Employee benefit programs, again, that might be a retirement account, that might be, meals for your employees if you order in meals, retirement contributions, HSA accounts, other things of that nature. Insurance, other than help, line 15, again, so automobile, E&O insurance, general business insurance, your umbrella policy, things of that nature. That's where your insurance goes. Interest, you have a loan, you have an SBA loan, you have a mortgage loan, anything paid to banks, that's line 16. My favorite, box 17, legal and professional services. So your accountant fee goes there, your legal fees go there, any payroll fees go there usually. So that's line 17, legal and professional fees. Office expenses. Again, office expenses, operating supplies, depending on your industry. A lot of the stuff tends to lay over, or it can be intermingled depending on how you want to look at it. But at the end of the day, potato, potato. If it's an ordinary and necessary business expense, you should be taking it. Pension and profit sharing plans, box 19. I'm going blind. Again, self-explanatory. Line 20, rent or lease. So A, vehicles, machinery, and equipment, right? Let's say you're a medical spa and you lease your car. So you would put that there. And if you have laser hair removal machines that you're leasing, that would also go there. Other business property, line 20B, well, obviously your monthly rent is a part of that. Repairs and maintenance, line 21, self-explanatory. You have a hole in the wall, you have a leak, something small, repairs and maintenance on your automobile. Again, that's a write-off as long as it's for business or business related. Supplies. Again, let's say you're a medical spa, supplies, you're going to have gel, you're going to have lotion, you're going to have needles, you're going to have a ton of different stuff that falls under supplies, which could coincidentally also fall into your cost of goods sold. So there's never, potato, potato, same thing. At the end of the day, it's a business write-off. Make sure it goes somewhere. And as long as you can substantiate it, you don't have anything to worry about. Line 23, taxes and licenses. So again, self-explanatory. Travel and meals, travel, deductible meals. Self-explanatory. Utilities. Again, if you have an office, you obviously have, well, not obviously, but you probably more than likely are paying utilities out of there. So your utilities go there. Other expenses, line 48. So this comes from page 2. So what are other expenses? Well, other expenses are things that they left off that might not have been covered here. For example, your cell phone was not covered here. Your computer was not covered here. Offbeat stuff, that you might not necessarily think of goes under other expenses. But for the most part, you should have everything covered there. But if you don't, put it to other expenses. So now let's talk about it conceptually, right? Let's say you're a realtor, you pull in $100,000 for the year, and you show rent of, $50,000. Is that going to raise a red flag? Probably. Is that reasonable? If you're a startup, maybe, but probably not, or let's use better numbers. Let's say you're pulling in $30,000 and you say your rent's $24,000. Is that going to raise a red flag? Yeah, more likely than not. So again, if it's a legitimate business expense and that's what you sincerely incurred, then I would suggest obviously doing it because that's what you paid out, especially if you're a startup. On the flip side, if you're just adding fluff there to make it up, to get a bigger refund, to offset it against your W-2 income, obviously that's A, against the law, and B, not suggested, not worth doing. So when I first started out my business, I had to report it on here because I was the sole proprietor, and then eventually I incorporated. And, the reason I incorporated was A, it just sounds much better from a professional standpoint. B, I feel like the tax benefits were better or are better with an S corporation. And basically, in my opinion, listen, if you're pulling in $10, $20, $30, $40, $50,000 a year or more, hire an accountant. Now, unfortunately, there's a lot of bad accountants out there. There's a lot of accountants out there who don't have common sense, who probably shouldn't have a driver's license. And on the flip side, there's a lot of good accountants. But basically, if you have a business, to spend a couple $100 a year to have somebody prepare this professionally and make sure everything is correct and in line and being, allocated or, apportioned to the proper accounts, that's huge. Right. And, they should more than pay for themselves in that fee by giving you advice, giving you feedback, giving you good suggestions. And, I can't emphasize the importance enough. I wouldn't, do my own brake job on my car, right? It would be a nightmare. So yes, can you probably figure this form out on your own? Is it suggested? Probably not. So hopefully you found this helpful. If you listened and watched this far, please smash the like button. And if you want me to share about anything else, leave a comment below. Have a great day.